Hello, everyone. Welcome back to the Saigal Seatrade podcast, your go-to port of call for everything shipping. I'm your host, Sounakh, and today's episode is all about volatility. We've seen war premiums skyrocket, ceasefires flicker in and out like faulty radar signals, and rate charts that look more like roller coasters. But underneath the noise, what's really going up with tankers? To navigate this chaos, I'm joined again by shipping expert Sandesh, who's here to break it all down. Sandesh, welcome.
Thank you, Shaunak. Thanks for inviting me once again. It's pleasure to be here. Thanks.
So let's kick things off with what's everyone watching right now, the VLCCs. The swings this past week were unreal. XMEG China plunging from the world scale 110 to world scale 57. That's not a correction, that's a free fall. Sandesh, walk us through what just happened. Why did rates explode early in the week and collapse just as fast?
Thank you, Shaunak, and you're absolutely right. It's been a turbulent ride in the VLCC segment. The week it kind of opened with serious hit. The US, they have launched coordinated strikes on the Iranian infrastructure, and within hours, risk premium surged. Then the owners, they kind of began holding back tonnage specifically for the MEG stems. And the idea was if you are risking hull and crew near the Strait of Hormuz, you are going to settle for the last done levels. So rates on MEG China flirted with the world scale of 110 with, whispers even higher. But then midweek the narrative shifted. We have seen a fragile ceasefire. It was brokered between Israel and Iran on June 23, and suddenly that war risk bid evaporated. Now the owners who had held back earlier rushed to get their ship fixed. Then we have seen the tonnage list. It's kind of a balloon, specifically front end, and charters they remarked cargoes aggressively. So by the week's end, we was staring at world scale 57 for MEG China, and it was a 48% drop in just a few days. We have a benchmark route TD3C. It dropped 34% week on week to world scale 53.95, and then the TD2 MEG US Gulf it also shed 27.8% to settle at world scale 56.11. Then US Gulf China, another benchmark route, it fell 5% week on week to 7.57 million. And with some owners guiding closer to 7.5 million for the next run. So the pace and the scale of this particular reversal, it kind of underscores how fragile sentiments is, when the geopolitical noise is the main driver. The underlying fundamentals, specifically supply out of Middle East Gulf and then weak global refinery runs, they haven't really changed. But when traders smell a risk, rates run, and when that risk fades, they fall harder.
So let's shift gears to the Atlantic. West Africa and the US Gulf. Rates surged early last week, then gave up those gains just as quickly. What's the story here, and how much of it was just sentiment spillover from the MEG?
The big chunk of the early week rally in the Atlantic VLCC market was what I would call a kind of a imported sentiments because the MEG it's on fire and that spilled into WAF and USG. So charterers, specifically for the Brazil bound steams, they were nervous. One bullish structure out of Brazil, pushed WAF China to a 5-month high. But the fundamental in the Atlantic never really supported that kind of surge. And once the Middle East Gulf cooled off midweek, owners lost pricing power very, very quickly. And USD China, it peaked at around 7.975 million on a lump sum basis before it retracting to 7.7 million by the week's end. And WAF China, it also dropped in tandem. So TD15, the benchmark, the WAF China, it fell around 26.3% week on week to world scale 53.56. But here is the key observation. The narrowing spread between USG UKC and USG China is kind of sending a warning signal. And what it tells us that owners aren't being compensated enough for the longer haul, which means the arbitrage window is kind of a tightening. So until we see a fresh wave of USG export or, kind of a surging Chinese demand, this market could remain under pressure specifically for the VLCCs.
Okay, alright. Let's bring in the mid-sized tankers, Suezmaxes and Aframaxes. Were they just following the VLCC lead last week, or was something else at play?
Well, Shaunak, thanks for that question. Actually, it's a good question. So, Suez Maxes, specifically ex-MEG, that is Middle East Gulf, were almost kind of passive observers early last week. And then the activities was thin. But VLCC spiked midweek is, impacting the Suezmax. Then the Suezmax started to tighten. So there was a short burst of bullish sentiment, westbound steams. They kind of picked up interest and some owners held back tonnage hoping for the rate to pop further. But by Friday, VLCCs had already collapsed and Suezmax sentiments also deflated in line. So TD6 Black Sea Med and TD WAF UKC, the benchmark both fell 0.82% and 0.93% week on week to world scale 103.3 and world scale 88.89. Now the WAP Suezmaxes was more dynamic. Charterers played it very smartly because controlling the pace of cargo releases to temper the rally. By week's end, new cargoes emerge and the tonnage list is tightened again. But without firm fixture evidence, owners were guessing the market. Aframax saw more excitement because the TD8 AG Singapore index it surged early, peaking at world scale 182.14 due to congestion concerns, specifically with respect to the hull risk through Hormuz. Then we saw MRPL, Indian PSU booked AG West Coast India cargoes at very firm levels. And it was reportedly at world scale 195. But the front end supply kind of increased and a few failed fixtures cracked the sentiments. TD8, it again kind of closed at world scale 167.14 and it's still up 4.7% week on week. So over in Southeast Asia, TD14, another benchmark, it rose 1.3% to world scale 127.25. So with the end June tonnage list tightening, again all eyes are on early July window.
Okay, so let's talk clean tankers now. I mean, LR and MR rates didn't just soften, they collapsed. What caused such a steep fall in earnings across the board?
Well, Shaunak, last week was nothing short of brutal for the clean product tankers. So let's start with the numbers. We have seen TC1, the 75 KT AG Japan LR2 route, it dropped 68.6 point to world scale 143.61 and that crushed the TC earnings by 22,067 per day to just below $31,800 per day. And it was a 22.6% week on week plunge. Now LR1s fared worse because TC5 it also dropped 71 points to world scale 145.94 with TC again down just below $16,500 per day, to just $21,109 per day. It was again more than 48% drop. And then the MR weren't spared either. Both TC12 and TC70 again fault and overall TC down by over 20k per day for route AG East Africa. So the reasons you might ask, first that is seasonal softness. We are past peak spring maintenance driven flows and second the ceasefire between Israel and Iran on June 23 allowed regional clean trades to stabilize. So no more war risk induced panic booking. Plus, the tonnage rates ballooned specifically on the LR1s and LR2s as vessel rushed back into the spot pool. So for foreign markets also reflect a kind of a contango sentiments and suggesting bearish near-term expectations. So demand-wise, MEG jet fuel demand it fell around 10% to 0.48 million barrels per day, while Chinese clean export are rising in July to 3.88 million metric tons to around 8.7% month on month increase. So it was driven by gas oil and gasoline and it's not enough to tighten the global fleet. So structurally oversupply is still lingering problem with CPP fleet is growing 4.9% in 2025 versus just 0.9% seaborne volume growth and that's the 5x mismatch.
Okay, Sandesh, before we wrap, we have got to touch on the LPG market as well. It's been flying under the radar for some, but this past week had some real fireworks. Was the latest on VLGC fret, and is the Panama Canal mess still distorting flows?
Well, the market in the East, it kind of exhibited a relatively independent movement across the last week actually. So last week, it kind of began with the rates in the high 80s on the BLPG1 index. However, midweek we saw kind of a sharp correction following the announcement of ceasefire in the Israel-Iran conflict, which was brokered by President Trump. And you know what? This kind of eased geopolitical tensions for a bit, and that has impacted the LPG shipping market and it brought the freight levels down. So, toward the latter part of the week, the market is stabilized and moved sideways around the $80 mark. So, looking ahead, similar sideways trend is expected as the reduced risk premiums in the Strait of Hormuz are counterbalanced by tightening vessel availability. Now, in addition to that, a seasonal increase in the LPG demand, it may lend some upward support, although a mild correction cannot be ruled out. So, in the start of the last week, charterers hedged their sourcing by shifting from eastern markets to western market. But this week or the upcoming week, we expect their return soon for the eastern market. Now, in the west of Suez, the VLGC market remained very firm with the BLPG3 rates kind of holding steady in the mid 120s throughout the week. So, a slight softening was observed toward the end of the week, but the overall tone, it kind of stayed resilient. So, the short term outlook suggests a modest easing in rates due to improved vessel availability as related tonnage continued to return to the US Gulf. However, any downside is likely to be limited as the market could find support from the upcoming seasonal demand growth. So overall, the Western market may see some temporary softness before stabilizing again. We have seen the arbitrage opportunity also seems to be limited compared to the last week. About 7-8 prompt vessels are about to roll on the July dates because of the lack of arbitrage opportunity and kind of a prompt requirement from the eastern charters, and as the market balances out in the east as the geopolitical tension eases.
Okay, thank you, Sandesh. That's a wrap for this week's Saigal Seatrade podcast. Thank you so much for that deep dive. It's clear this market is now moving fast, and you have helped us decide it with incredible clarity. To our listeners, whether you're trading cargoes, managing fleets, or just obsessed with freight volatility like we are, stay sharp, stay subscribed, and we'll catch you next week on Saigal Seatrade. Thank you so much.